Lesson 15, Trading Pennants. Before we get started, I'd like to point out a couple things. In the top left-hand corner, you'll see a sign that says important information. During the presentation here, during this lesson, that sign will appear on certain pages. The information that's on that page is very important information that can play a big part in helping you as you trade. It can perhaps be a trader's tip. Pay attention to that information. You may want to memorize it and have it become a part of your methodology. The second thing I'd like to point out is in the bottom center of the page is a number. That is the number slide that we are currently on. That number matches the number in your workbook. If by chance you get lost during this presentation, look at the number of the slide and match it up with the number in your workbook. There's 16 lessons on trading the Forex to help you. This lesson, lesson 15, Trading Pennants, plays a big part in trading and in anticipating great profitable trades. Our focus here at MarketTraders.com is to take the market, which can be very, very complicated, and simplify it to where you can understand how to trade it and how to make money as you trade. Learning to trade the pennant is one of those very simplistic ways in learning how to trade the market. It is a part of technical analysis. These 16 lessons on trading the Forex are lessons on technical analysis. They are applicable to other markets that you trade. One of the most profound statements, as you've heard me say this before, is successful traders will do what unsuccessful traders can't and won't do. I commend you on taking the time to learn how to trade and to learn how the market works. Successful people think, act, and perform differently than unsuccessful people. They form habits of success. They are successful in spite of themselves because they've acquired a subconscious discipline that allows them to be successful. Please take the time to acquire that subconscious discipline so that you too can become a successful trader. There is a 21-day 3% rule which states the human mind forgets 80% of the knowledge it acquires within 3 days. If you don't use it, you lose it, because over the next 18 days it continues the loss of information until it settles at retaining only 3% of the original acquired information. By the end of this lesson, you will learn how to find an up and down price swing. You will learn why pennants form. You will learn that the market consolidates in a natural Fibonacci 618, 786 numerical sequence. You will learn how to find and draw a pennant. You will learn how to locate the buy and sell zones of the pennant. You will learn how to trade a pennant. You will learn how to create a trading plan with that pennant, and hopefully you will be disciplined and trade your plan. You will learn where to place your protective stop-loss orders and how to financially protect yourself in every trade. Before we get started, let's review lesson 1 real quick. We're watching Japanese candlesticks which monitor the open, high, low, and close. The bullish candles are white candles. The bearish candles are black candles. We are watching a bid chart. There is a bid and an ask as we trade. This is like an auction. If you've ever been at an auction, there are bidders trying to buy. Bidders are always quoting a lower price than the auctioneer. They're trying to buy it cheaper. The bid price is lower than the ask price. The auctioneer is asking a higher price. He's offering the product for sale. That's where the bid ask comes from. In trading, there is a bid and an ask, and the ask price will always be higher. When it comes to trading currencies, the ask price is anywhere from 3 to 10 pips higher than the bid price. Please remember this. We are looking at bid charts, and we buy on the ask because buyers buy from sellers, and sellers sell to bidders, which means we sell on the bid. It's important information. Why is it important? It's because if you enter the market right now and you buy, you'll be buying on the ask. Here's the current price, 107.30, which means the ask price is 107.35. You have now been filled at 107.35, not 107.30. Every buy needs two sells, one for a protective loss stop and one for a limit to get out. Your sell stops as well as your sell limit on a buy will be on the bid. All this candle has to do is hit that number and chances are you are filled. Here's where it really comes into play because we sell on the bid. If we enter the market right now, we're filled at 107.30. The ask price is higher. If we place a protective loss stop, all it takes is for the market to come up and the candle does not have to hit that because the ask price is higher than the bid. The ask will hit your buy stop before the candle will. Many times the candle comes up, doesn't hit your ask price, the prices fall again. You are really excited and thankful that you're not stopped out, yet you are stopped out. So just in case when the market gets close to your price, always confirm and understand whether you are whether your stop is on the bid or the ask. Understand that so that you can properly understand what you should do next as you continue to trade. The types of orders we use are market orders. That's an order placed to enter or exit the market at the market price, either the bid or the ask, or whatever the market price is at the time of execution. The second order is a limit order. That's an order placed to enter or exit the market at the exact place price or better with no slippage. Now a stop order is an order placed to enter or exit the market at an exact price that turns into a market order when touched and may incur slippage. These are the rules as you trade. If this is where the market is, any order placed above or below the market that is not a filled order is what's called an open or working unfilled order. And if you place an order to buy above the market, that's called a stop order. If you place an order to sell above the market, that's called a limit order. If you place an order to buy below the market, that's called a limit order. If you place an order to sell below the market, that's called a stop order. It's something that may be difficult to memorize at first, but it will become natural as you begin to trade. Ordering rules. Every bull that enters the market should have two sells, one for a potential loss and one for profit. Let's look at this chart. If you buy to enter the market here, your protective loss stop order should be at the last low, which would be a sell stop. Every buy should have two sells, one for loss and one for profit. Now, focus in on your losses first and the profits will take care of themselves. Ordering rules. Every sell should have two buys, one for potential loss and one for profit. Let's look at this chart. If you enter the market selling, your stop loss order should go at the last high and it will be a buy stop. Every sell has two buys, one for potential loss and one for profit. OCO means whichever order the market hits first, it will cancel the other order. Whether you are buying or selling, you will need two opposing orders, one for profit and one for loss. Whichever the market hits first will cancel the other order, therefore you're not left with an open order. Cancel and replacing. We focus in on cancel and replacing in lesson 16 as well as lesson 3. Remember this important tip. Only cancel and replace as you are chasing the market to the last low after the market has made a new high when you are canceling and replacing in an uptrend. When you are canceling and replacing in a downtrend, only cancel and replace to the new last high after the market has made a new low. Sometimes it's very difficult, especially during periods like this, to stay in there, but you don't want to get stopped out prematurely. Technical traders learn to read charts just like doctors learn to read x-rays. To the trained eye, charts are telling a story. Technical analysis gives a trader a high probability of knowing where the market is going. Why do you think that's so? I'll tell you why. Who trades in the market? Banks, financial institutions, investors? That's partially true. But those banks and institutions and investors are people. They are creatures of habit. People are creatures of habit. Charts do nothing more than monitor the buying and selling habits of people. And since people are creatures of habit, we become predictable. That's why charts can become predictable, and that's why people that study charts, technical analysts, can create and understand and have a high probability of knowing where the market is going to go. And because a chart is a chart is a chart, technical analysis is applicable to all financial products, which means once you've educated yourself on how the market works, you can start to control your financial future. I'd like to do a quick review on support and resistance, which is lesson 2. Keep in mind that a high is the wick or the body of a candle that is higher than the 2 candles to the left and 2 candles to the right, and that not all highs are resistance. A low is the wick or the candle which is lower than 2 candles to the left and 2 candles to the right, and that not all lows are support. What we're trying to do is teach you to train your eyes to scan a chart. If this is where the market is, we want your eyes to scan a chart and be able to see all your levels of resistance and all your levels of support. Keep in mind the financial game, don't underestimate it, that we show you in lesson 2, which is if bulls take control, they're going to try to take out all these old levels of resistance and establish a new level of resistance. If the bears take control, they're going to try to take out all these lows and establish a new level of support. Your protective stop loss orders must be at the last high if you're buying and the last low, let me back up here again. All protective stop loss orders must be at the last low if you're buying and the last high if you're selling. Now let's look at this chart. If you are buying, your protective stop loss order must be at the last low or level of support. If you are a bear and you're selling, your protective stop loss order must be at the last high or level of resistance. If the stop order is too far away from the entry point that you are trying to get in and does not meet your equity management requirements, then pass on the trade. Don't risk more than you should. And your level of risk is pointed out in lesson 3 called equity management. Now before we move on, I'd like to review trends and trend lines just briefly. Keep in mind that an uptrend is when the market is making higher highs and higher lows, and that in order to find your uptrend line, you draw your trend line across the lows of support, just as you see it here in this chart. In an uptrend, there are 3 primary trend lines that we're constantly monitoring: the inner, outer, and long-term trend line. Lesson 5 teaches you where to enter the market at trend lines. In a downtrend, it works the exact opposite. A downtrend is creating lower lows and lower highs. When you spot a downtrend, you will draw your trend line across the highs of resistance, just like you see it in this chart. There are 3 trend lines that we're monitoring in a downtrend. One is called an outer, long term, plain old outer, and an inner. A quick review of lesson 7 is necessary for understanding your pennants, and that is where we learned that the market moves in a natural harmonic vibratory sequence, a numerical sequence called Fibonacci sequence. Leonardo Fibonacci in the year 900 AD discovered this numerical sequence. It's where the sum of the previous 2 equal the sum of the next. He started playing around with ratios in those numbers and started dividing the numbers. Where you take 89 divided by 144, you come up with 0.618. You take 144 divided by 233, you come up with 0.618. As you start to divide all these numbers, we came up with important ratio numbers that we can use in the market. One is a 382, a 50, a 618, a 786, a 1.27, and a 1.618. And we assigned certain ratios to other ratio extension numbers. Now, Fibonacci ratios are hidden levels of support in an upswing, which means as the market rallies and it retraces, if the upswing is going to stay consistent, it will bounce at one of these Fibonacci numbers. If it bounces at a 382, 50, or 618, it should go to a 1.618, just as you see in this chart. Market rallies, retraces to the 382. This is the 382, 50, 618, 786. These are your extensions, 1.27, 1.618. If the market retraces all the way to a 786, bounces, U-turns, rallies, and takes out the previous high, it will only go to a 1.27 extension. The market is signaling to the trader that it is slowing down when it bounces at a 786. We also learn that the market moves at different speeds. At a 382 bounce, it is very fast and aggressive. At a 786 bounce, it is slowing down. Downswings work exactly opposite, but in the same numerical sequence. In a downswing, if the market, as it retraces, bounces at one of these numbers then become hidden levels of potential resistance. Now in a downswing, if the market bounces at a 382, 50, or 618, U-turns, takes out the previous low, it should go to the 1.618, just as you see in this chart. This is the downswing. These are the retracements, 382, 50, 618, 786. This would be a return of 100%. It bounced at a 382, U-turned. This then becomes the extension, the 1.27 extension, 1.618 extension. There's the bounce. If it bounces at a 382, it should go to a 1.618. If the market bounces at a 786, it is slowing down. If it bounces there, U-turns, takes out the low, it should only go to the 1.27 as you see it here. Here's the original swing. There's the 786 bounce. There's where it went to the 1.27 extension. If you have a data provider that does not have the Fibonacci numbers on it, please give us a call and we'll hook you up with a great data provider that has all the Fibonacci tools. Keep in mind, once again, in a downswing, a 382 bounce is very fast and aggressive. As it bounces to a 50, 618, or 786, it is slowing down. And the reason you want to trade 618, 786 bounces in the direction of the trend is just in case the market decides to top out there, reverse, U-turn, your losses will be small. Here's another important information. If you listen to the market with your eyes and look where it has been, it will tell you where it's going to go. Now, let's look at this chart. Market rallied, retraced, bounced at a 618, which means if we entered at a 618, we planned on getting out at a 1.618. But instead, when it rallied, it did not take out the previous high. It U-turned and came back to the 786. This formation is called a Gartley. Well worth your investment to purchase lesson 13 and understand how the Gartley works. Here, with a new adjusted trend line, bounces at a 786 and rallies to the 1.27 extension, which means if we entered the 618 with anticipation of